Hello everyone. Let's look at chapter 10 having to do with property exchanges. We're going to look at basis and how that's determined, as well as some non-taxable exchanges by the time we're done with our podcast on this particular chapter. So getting right in here. First of all, the point of all this is from a tax standpoint, you need to figure out how much gain or loss is going to be reported on the tax return. And the first thing that we need to know is how much gain or loss is realized. And then we can calculate how much is recognized. But what we mean is realized is literally the economic gain from a transfer of the property. And that's calculated by taking amount realized minus the adjusted basis. So here's two terms we need to worry about: amount realized and adjusted basis. So let's look at both of those. Okay, amount realized is the fair market value of everything received. Now, most of the time that's going to be cash. You're going to transfer an asset and you're going to receive cash, and therefore there's no real challenge in calculating the fair market value. That includes any debt the buyer assumes. So if someone buys your house and assumes your mortgage, then the amount you realize or receive is the amount of cash they give you plus the mortgage that they assume. Selling expenses always reduce the amount realized. Closing costs, that sort of thing. So when it's not cash, then we have a little harder challenge, and that is looking at the fair market value of what you receive. So that is defined in the tax law as basically an arm's length transaction, what it was really worth, assuming that both buyer and seller have reasonable knowledge. So we're selling land. Buyer pays us $30,000 and gives us a truck. So the question is, what's the truck worth? It says $12,000, and we'd have to have a reasonable way of coming up with that. The basis in the truck's $25,000. He paid for $25,000. That doesn't really matter. What we're worried about is the amount realized, and that is the cash plus the fair market value of the truck. Second example, we got $200,000 in cash and they assume our mortgage, and we have to pay out of that $10,000 in selling expenses. So we add the amount of the mortgage assumed, and then we subtract out our selling costs. So once you have the amount realized, then you can subtract the adjusted basis. So what does that mean? What is adjusted basis? Well, you have your basis that you start with, the initial basis, which most of the time is what you paid for it, and then you add your capital additions and you subtract capital recoveries. That gives you your adjusted basis. All right? So if we buy it, it's just what we paid, including, it doesn't matter how we got the money to buy it. If we borrow it or whatever, it's still included. This includes all the costs to get it ready to use. There's some examples of things that go into the basis. Capital additions are things that we pay on top of it in order that make the value higher or defend the title. So if you buy property and you pay commissions or you pay legal fees to get it title transferred, all those costs are part of the original cost or original basis, capital additions. Then after that, you have improvements. And this is where things get a little complicated, and that is, does it increase the property value, make it last longer, or convert it to a different use? Or does it just make it back to where it was, which is what repairs and maintenance is? And there are all kinds of tax court cases and fights between the IRS and various companies about what is an improvement and what is a repair maintenance. And so this sounds simple, but it is not in practice. We're not going to get into all of the issues, but you should realize that it is somewhat complex. The general idea is that if it's an improvement, it's a capital addition. So here's some examples that may be capital additions, have been found to be capital additions. So, $100,000 for the original home, $15,000 to remodel, $18,000 to keep the home in good operating condition. We add in the $15,000, but not the $18,000 because it's maintenance. But $15,000 adds to the adjusted basis is considered an improvement. Okay. Capital recoveries is another name for the most part is about depreciation. Okay, these other things happen very seldomly, but most of the time depreciation is the issue. If an asset is not entitled to depreciation because it's not a business asset, it's not a rental asset, it's a personal asset, then that would not apply. There would be no capital recoveries. All right, so this is on business property. So, example, $80,000 we paid, deducted $11,000 for depreciation, and $25,000 for repairs and maintenance. $25,000 for repairs and maintenance doesn't count, but the $11,000 reduces our basis. So the adjusted basis is what we started at 80, subtract the depreciation. All right. Basket purchases, we'll go through this quickly. If you buy assets that are together, you have to take your cost and allocate it based on the fair value of each of the properties. Example, so you paid $100,000, the fair market value of the properties is $120,000 in theory, or at least that's what appraisal said. So you allocate the cost you paid based on a percentage of the total paid. Okay. Now, there's other ways that you can have initial basis other than purchase. You can get it from your spouse as an inheritance, as a gift, and converting from personal to business use. We'll see some of the stuff about stock splits, stock dividends later. But then now we're going to look at these various scenarios and how that determines our basis. So now we're not buying property, we're getting it in another way. Remember, this is more rare, it's not going to happen that often, but it does happen fairly commonly. From the spouse, your basis just carries over. There are no gain or loss, no changes if there's distributed, and we're usually talking about at a divorce proceedings. Inherited property, a little more complicated. Someone dies and leaves you something. Fair value, it could be one of three things. It can be either the fair market value on the date of death, the alternative valuation date, or the date it's distributed. All right? So if you don't file estate tax return, most people do not, so this is going to be your default, then it is the fair value on the date of death. So when they pass away, whatever it was worth and you inherit it, that becomes your basis. If that tax return estate tax return is filed, they use the alternative valuation date, then it is the fair value at either the AVD or the date distributed if it's sooner. So the value, it was $50,000. It was $56,000 6 months later. So there's your two amounts. If it's not filed, then you use the $50,000 date of death value. All right. If you distribute it 16, notice this is after the AVD. Any distributions after the date, we use the 56,000 because that's the AVD value. Anytime after. If it's before, notice this is before the AVD, then we use the value on the date of distribution. Gifted property depends on the fair value at the time of the gift and the adjusted basis. All right, so here's our fair value. It's less than our donor basis. Thus, our first consideration is that the fair value on the date of gift is lower than what the donor, the person who's giving the gift, basis. So whatever their basis is when they owned it, before they gave it. So now we're fast forward to when the donee, the receiver of the gift, sells it. All right? So if we have two values, fair market value at the date of gift and the donor's adjusted basis. If the donee sells it for lower, on this side of the spectrum over here, lower than the fair market value, then their basis is fair market value at the time of the gift. So basically, the loss that was inherent in the property when it was given doesn't count. If they sell for a gain, the basis is above the donor's adjusted basis. Okay? So this fair market value doesn't apply in this case. If you sell for anything over this, then you have a gain for the amount that's over the adjusted basis. And then if you sell anywhere in between, there's no gain or loss. Anything between the fair market value and the donor's adjusted basis, then there's no gain or loss. The basis is exactly the same as whatever you sell it for. Example, father's gift stock to his son. Fair market value at the time of the gift was $30,000. Adjusted basis was $70,000. So first of all, this should never happen. If they come and you ask for help with taxes, you tell them sell this stock, recognize the loss, then give the gift to the son. Don't give it in this way. Okay, just bad form doesn't help anybody. But if they don't listen to you, they do it anyway. Okay, at the time of the gift is $30,000, so the fair market value is below the adjusted basis. Okay, so when the son goes to sell it, if he sells it for less than 30, he has a loss between the 30 and whatever he sells it for. If it's between 30 and 70, no gain or loss. And if he sells it for over 70, then his basis is $70,000 and he gets a gain for the amount over the $70,000. Okay? Now with gifted property, you also have to consider the gift tax that's paid by the donor. Okay? If it is pre-1977, 100%, after that, it is part of the gift tax paid at the time of the gift, but never more than the fair market value. So fair market value of the land at the time of the gift was $100,000. Adjusted basis of the land was $40,000. Paid $15,000 in gift tax. So this is okay because the fair market value is higher than the adjusted basis. And in fact, he has a gain on it before the gift. Okay, so son's basis, he's going to get the $40,000 carryover from dad. Okay, plus a portion of the $15,000 gift tax. And the portion is the amount that the value increased while dad owned it divided by the total value. So 100 minus the 40 divided by the 100 times the gift tax, and then you add that to the original 40. Okay? And that doesn't exceed the fair market value, so we're good. All right, In our next one, we'll pick up with converted property, our next podcast.